So how do rising interest rates impact investors in general? And why does the stock and the bond market care about that? First of all, why are the rates rising? Usually it's because of inflation. So right now, I think the inflation rate just came out at 8%. But if you go to your bank, you're lucky to get 1% on your money. Last year it was basically, nothing, 0.0%. Now maybe you can get 1%, but inflation's at 8. You're going to lose 7% real money. So that puts pressure on interest rates to go up. And the bond market doesn't like that, and the stock market doesn't like that. Why doesn't the bond market like it? During COVID, the 10-year bond, the government bond, US government, was 0.4%. Then it went to 1.5% last year. Let's suppose you locked that in at 1.5%. Well, today it's almost 3%. So who wants your bond that's half the rate of today? You've still got 9 years left to go on it. So nobody wants it. The price is going to drop. So that if you tried to sell it, you could sell it, but you're going to take a little bit of a beating on it. You'll get your money back in 10 years, but you'll be stuck with a bad rate. So if you look at the bond market this year, which people think of as safe, it's down 9 to 10%. That's not so safe when rates are rising. Let's look at stock. Why does the stock market dislike interest rates to rise? A few reasons. One, it gets competition. If I'm a stock investor and I can't get anything on my bonds or my CDs at the bank, then maybe I'll buy more stock. But if I can get 3% or 4 or 5, then maybe I won't buy stock. So competition is one problem. Profit squeeze is another. Interest rates go up. Corporations have borrowing that they have from time to time. So their costs go up, their profits go down, and then what happens is the stock prices do not like lowering profits. So that's another reason. The third is the economy. Rates go up, mortgage rates go up. People can't afford the same level of house. They may not buy the house. They might not buy the furniture. It trickles around into the economy. And generally profits around different industries start to decline, and the stock market does not like that. If you think about stocks, they're really just a claim on future money. So, this company's producing money. In 10 years, it's going to make $10 million, let's say. What do I pay for that today? If interest rates are nothing and inflation is 0, I can probably pay $9 million today and I'll get $10 million in 10 years. But if inflation is where it is now, 8%, some say it's 10, then I don't want to pay much for money in the future. I might, give that company $3 million or $4 million for $10 million in the future. It's a lot less than when rates are 0. So the higher the rate, the less stocks are intrinsically worth. So what's the solution? Your stock investments should be thinking about, how do we counter this? Maybe you buy some stocks that benefit from inflation. Some of the energy stocks benefit from inflation. Some of the food stocks benefit from inflation. Some of the technology stocks, sometimes they don't like inflation and they may not perform as well. And on the bond side, you just have to be careful. Maybe you don't lock in 10 or 20-year bonds. Now, of course, investors should have been thinking about this ahead of time. We were contemplating it a few years ago, and a couple years ago we started making some adjustments. Is it too late now? Some think it's, we're in the early innings of an inflation problem. It's hard to tell. So you need to be flexible, and you need to be cautious if you're going to make any big changes, as always.